As a dentist, doctor, or small business owner, you're probably feeling the weight of balancing your demanding practice with your personal life, right? It's tough to find the time for family, to focus on your health, or even think about your financial future when you're always grinding away at work. To the Dr. Josh Cochran Show, where I'll focus on empowering professionals like you to build passive income and achieve financial independence through real estate and smart investment strategies. Each episode, you'll discover practical steps and real-world stories to help you create long-term wealth and gain more time to focus on what really matters: health, family, and freedom. You're ready to break the cycle and start living on your own terms. This show is for you. Welcome to the Dr. Josh Cochran Show, Wealth, Health, Family, Freedom, for doctors, dentists, and business owners. Brought to you by Cochran Capital, thoughtfully designed investment portfolios for accelerated wealth building, sophisticated strategies to defer or eliminate capital gains, depreciation recapture, and ordinary income taxes. Build the future you deserve. Just a heads up, everything we talk about on this podcast is just our personal opinions and experiences. We are not giving legal, financial, tax, or accounting advice. So don't take it that way. Be sure to talk to qualified professionals before making any big decisions. We're just here to share ideas, have real conversations, and hopefully help you think a little differently. With me today is the Wonder Kid, Dr. Reed. Reed, how do you pronounce your last name?
I have to tell people, I break it down into fall, like you're gonna fall into a hole, and then debt, as in you owe money. So fall debt.
Faldet. Faldet.
Yeah.
Okay, cool.
I get some funny ones. I've been in dental school, I was called Fallet by a professor that I thought I was French, but
Yep.
off the
Yeah.
mark there. So I figure some interesting ones. But yeah, fall debt is how you
Yeah.
pronounce it.
It's like that actor, Timothy Chalamet. Like he's got the T on the end. So everyone who interviews him is like, how do I do this? And he's always like, I
Yep.
don't care. Just call me whatever.
Yep.
Uh, yeah, in the news this week, HUD is making major cuts. HUD does a lot of the lending on multifamily. That's how it affects real estate. And, this show is about wealth, health, family, freedom. And the best way to get the wealth is get your dental practice going and then get into real estate, right? The returns are so much better. The lack of taxes, the passive nature of things once you get things going. So yeah, so HUD is cutting a lot of their staff, but they're also cutting a lot of their affordable housing programs. So, when you cut affordable housing programs, what happens to people? We got to remember, like at the top of the government, like now it's just people, right? It's like a table of I forget what the number is. It's like 8 people just making these
Oh,
plans, right? And
yep.
so when they come up with these ideas, it's up to us to interpret that and kind of see what the consequences are going to be, right? So we know that HUD's getting shrunken down. The administration stated that it wants to ramp up housing. So they're going to, that's one thing they're going to do. And mainly through, they're focused on lowering interest rates, right? So if they're cutting gifts, right? They're cutting
Subsidies.
funds, subsidies are given to states, but they're increasing. They're trying to ramp things up instead of giving things away. They're trying to incentivize, right? So lower interest rates. Let the private market take over and grow housing
Mhm.
to make it more affordable, right? So it's a different approach. But you are going to see people displaced from housing. There's going to be a lot of uproar on that. The second big news item that I saw was the agreement with UK over tariffs, right? So we came out guns ablazing, saying we're going to tariff everybody big, anchor points. It's a strong negotiating tactic, and then you kind of back off and you find a nice equilibrium. And Howard Lutnick, who ran a successful hedge fund in New York for many many years, and joined the Trump administration, and now his sons are running it for him. This, to my understanding, this is his brainchild. It's like, hey, let's bring back tariffs. Let's tax goods coming into the country, which will probably increase prices, right?
Mhm.
But the idea here is if we can get our tax income from tariffs, then we don't need to charge as much on ordinary income tax, capital gain tax, like these other taxes that are taxed at more of an income or profit level. We can reduce those and instead tax on tariffs, which is like a consumption tax, right? So now
Mhm.
instead of taxing people on how much they produce, you're taxing people on how much they consume. So it's kind of a shift in thinking back to how the government used to be run,
Mhm.
and it's going to be a lot of pain in the transition, but that's where they're headed. And so the idea is if you don't tax people on their income, then they use that money to spend it on things, right? So it's just a different approach to stuff.
Yeah.
Um, Reed, I know
It's
you
more.
keep up
Go
on
ahead.
this stuff. Yo, go
Well, I'm
for it.
just saying it's more of an opt-in than anything else, right? Because you can choose to make the purchase that you're going to get taxed on. So it's almost making it more. It's your choice, right? Whether you pay it or not. Um, but the thought. So there's kind of three legs to the tariff strategy, right? Which is one, maybe income source. Um, Two was a negotiating tactic to just kind of make trade a little bit more equal with some of our partners that are kind of above us on deficits. And then three was to kind of put pressure on key infrastructure that we need to bring back to the country. And I'm not talking about and I'm not political by any means, but this is just my understanding of what the strategy is. So there's kind of three different parts of it. I'm not political. Um, I definitely don't understand the geopolitical area at all, but I try to think of like, what are they actually trying to accomplish? And could they accomplish all three of these things? Or is there one that's kind of the primary, secondary, and tertiary kind of um, motivations behind it in the first place? And I don't know. And I guess maybe chasing three things at once, even if they settle on winning one or two of those things, it's an overall win. It's hard to say. But yeah, I thought it was kind of what I take from it that's actually most interesting is that the the light that it's shed on just our reliance on other countries for a lot of our key things like um, electric motors and rare earth minerals and all those things that I didn't even know about. Right? I was not even political. I was not plugged in enough to know current events and be political enough to understand where we were kind of weak in certain areas and where we could be exploited and where other countries could use leverage against us to really change like our way of life. So I think from a defense perspective and from maintaining like sovereignty, that seemed like more of what was more important than anything else when I was kind of listening to the different debates about it. But yeah,
Agreed.
definitely not an expert.
If you don't have national security, national security, nothing else really matters, right? So,
Oh,
yeah, I agree. And why we care is like if you understand what's happening macroeconomically, you can shift your strategies to get in line with that and prepare for those changes, and you just kind of be ahead of the curve instead of behind the curve. So it's always good to keep an eye out. Okay, so today, Reed and I want to talk a little bit about refinances. Interest rates went up. If anybody has gotten loans in the last couple years, interest rates have been coming down, and that's a key part of the Trump administration is to do the best they can to drive down interest rates. And even though they don't control the Fed, they do have a couple levers that they're working on to get those rates down. And primarily they focus on like the 10-year treasury. And one of the big motivators there is if they can bring down the cost of 10 years treasuries is when we refinance our government debt, we can refinance at a lower rate, right? So if we've got 30 trillion in debt, just getting that rate down a little bit makes a huge difference. So Reed and I both owners of real estate. As rates have started to come down, we have properties that are different at different times in their life cycle, right? So maybe you just buy like a stabilized deal and you buy it with a certain loan, and maybe rates come down. You're looking at like, when do I refi? Most commercial loans, have a 5-year fixed portion to them. You can do 7 year, you can do 10-year fixed, but most have five. Same with multifamily, usually 5 to 10 year on the fixed piece. And so, you know, every year you got to look at your portfolio of real estate and think like, do I refi? Do I not? Yeah. Reed, what are your thoughts?
Yeah, it's not something that's fun to look at when you're locked into a decent interest rate. And then you look at, oh shoot, this is what my cash flow is going to drop to, or maybe I'll have to put some more money back into this property to kind of get the debt service coverage ratio where I want it. And so it really just, like you said, depends on where you are in the loan cycle, right? Of like how close are you to that 5 year term coming due and where are interest rates now versus where they used to be? And have you built enough equity in the property where it's not going to be a problem, or was it already tight to begin with? So I'm not quite on a couple of my properties. I'm getting close within the next couple of years. Some of my properties have 3%, 4% interest rates, and so that's going to change. That's going to change the cash flow situation. But I'm hoping that by that point in time, I have enough equity that it's not such a big deal. So I don't think I need to push to refinance some of those yet. But I do always kind of look at it and have a pulse on it. So
There's risk, right? 5 year fixed is risk. I know some of the older guys, when interest rates were low, they were using a lot of CMBS insurance lending, 3%, right? And so CMBS, where were we? CMBS rates.
so why are these older guys using them
Yeah.
as
Yeah. So like insurance CMBS, so instead of doing like a 5 year lock, right? It's like a 30 year lock.
oh.
So, on a home, you can get a 30 year lock, but not typically on commercial. So if you go with like Life Co or something, you can get a 30 year lock, but they typically want you to have much more cash in, like 35, 40% cash in.
You,
So
you, you like loan to value, you're talking about.
loan to value. Yep. So the
Yep.
younger guys are like, hey, I want to refi, get my cash out as much as possible and snowball that into the next deal, right? Because we're in like um growth of the
Growth
wealth
mode.
base versus
Yep.
preservation, right?
Yep.
But I've noticed like all like the 60 year olds, they're like, I'm gonna lock this in at 3% for 30 years, be patient, and they're at a place where they don't need that capital to do the next deal. And so they're just maximizing cash flow and they've seen ups and downs, right? So yeah, I mean, I think that's one thing that I've noticed and that I've learned is like, hey, maybe next time we kind of hit a low on interest rates, maybe it's time to take less cash and just lock these things up for 30 years and let them cash flow. Because as you know, like multifamily is the easiest example. Usually about 2/3 is your net after expenses, right? And so if your expenses are 1/3, your net after expenses is 2/3. Well, every year, if those go up by 3%, you have your compounding growth curves, right? But this one's growing at a much faster rate. So if you've locked in that debt payment, right? Like it might seem like a big number today, but when your rents have, doubled 15 years from now, all of a sudden that loan number doesn't seem so big and you're super happy that you locked it in at a
Mm.
3% rate for 30 years. Um, yeah. So,
So,
yeah.
how do you have access to a lender like that? Is there, other than having more cash in the deal, where do you even go about finding someone?
Yeah.
Finding,
Yeah. So when you it's weird. The name there's a job out there, and it's usually called like capital markets. Okay. And these are firms that go out and find primarily debt, but sometimes equity, primarily debt for you. So right now, most dentists, doctors, entrepreneurs probably just call up the different local banks, right? They call up 3, 5 local banks, they form relationships, maybe some nationals like there's a couple national banks that love dental that just do great terms for dental. So you call those guys up, you figure out who is the best deal, you take down your loan. When you get more sophisticated and larger, right? Like on some of your multifamily properties that are a little larger, like the lenders, Fannie Mae, Freddie Mac, et cetera, all these guys, HUD, they don't want to work with you because they have they have their way they do things and their guidelines, and like training somebody to do that takes a lot of time. So what's developed is this middleman called capital markets folks. They go out to all the different banks, okay, depending on a type of deal, and different macroeconomic cycles, different types are better. But there's CMBS, there's life insurance, there's agency debt, which is all the government lending we just talked about. There's local banks, there's regional national banks. And depending on what you're looking for, they reach out to all of them. They usually have like a list of relationships with these banks, debt funds is another one. And they reach out to all these folks and say, hey, they put together an offering memorandum, right? Here's 20 pages about this property, whether it's a ground up development or it's a stabilized property looking to acquire. They send it to everybody, and they also send the financials, and then they get feedback on who's interested, and then they do a little bit deeper dive with them, and then usually they'll send you like a summary sheet of like, here are the 5 lenders that want to do this deal, here are the terms of each lender, and then you can make like an educated decision about what you want to do. Now, yeah, at the time, about 3 years ago, 4 years ago, agency debt is a good refinance of larger multifamily, but so was, like I said, Lifeco at that time. So
So is this considered a mortgage broker or is it called like a capital markets broker? What is that role?
yeah, they don't have one name, but yeah, I think a mortgage broker would be the term that like a consumer would use, right?
Okay.
Uh, but yeah, once you get up there, that they like to call themselves like capital markets. Now, they used to be all independent, right? They used to be like an independent business, but what happened about 10 years ago is the large brokerages, commercial real estate brokerages, started acquiring these capital markets teams and then brought them in-house. And so
Oh,
you'll see both independent houses, but you'll see like the larger brokerages all have this in-house now too, both ways. So
yeah, it benefits them to bring that in-house, so it makes sense. Like anything, you consolidate, bring it in-house if you have the means to do it. Yep.
and you're just solving people's problems, right? You're trying to bring together buyers and sellers. Well, the buyers need debt to buy, right? So if you can help them get there, I think they just decided like, hey, this is a profitable business. Like we're funneling all the business to these guys, a lot of it. Why don't we just bring this in-house, create it like an all-in-one solution for our clients?
Who pays the commission then to incentivize the person to package up the property and bring it to these capital markets? Is it the debt side or is it the person who's the lendee?
Yeah, the buyers pay. So
Okay.
usually about 1%. Um, so
Okay. That's good to know.
Yep. But the agency stuff, it's like required. They won't even talk to you. So, uh,
Yeah.
uh, yeah. So, but I think the idea too is, it takes a lot of work to like put your stuff together and bring it to all the local banks, right? But the local banks are receptive to less sophisticated borrowers, right? This is who they're here to serve, especially credit unions, right? When you get up to the larger borrowers, like
Can we
um,
qualify that? Can we qualify what a larger borrower is?
well, okay, so call up all your local banks and say, how much will you lend on a project? What's like your max lend, right? And maybe 4 or 5 years ago, I was getting like 20 million, 40 million, like per borrower, usually 5 to 40 million. Let's start there. Per borrower total as like all your stuff, 5 to 40 was the most. I think 20 was more popular on the top end. And then per
Okay.
deal, yeah, a lot of times it's like 5, 10 million, right? So you're trying to take down these bigger deals, and the local banks don't do that. They do something where they partner with other banks in the back end called syndication. Like 2, 3 banks will work together, but that a lot of banks don't have that desire to do that.
Yeah, it's
So
messier. Yep.
yeah, so you get to a certain size, and it's like, oh, okay, like who do I talk to? It's a lot of the other options that I mentioned, and then you need somebody who has those relationships on a, I might have a few of those relationships. So meeting somebody who has a lot of those relationships because, numbers are always changing, desires are always changing.
Yeah.
And then it's one less thing you have to do.
Yeah.
If you're running the show, right, you're wearing a lot of hats, and one of them is finding the best debt. If you could take somebody who takes all your data, all your pictures, all your data, all your pro formas, and packages them up into a really nice package for these lenders, speaking the language the lenders want to hear. And then also there are still like the bank regulations are huge right now. There's so many bank regulations, right? It's very restrictive, which means most of your loan products, especially with banks and credit unions, are going to look very similar. And it's got sense working on deregulating, right? So we should have some more variability in what different banks are offering. But there are still, even with all those regulations, there are still like a little loopholes where certain banks don't treat projects the same way. And these brokers are often aware of that. They figured out like the little ways to do it. Yep.
Yep.
And so like as a developer, right? I tried to maximize the value of my land when I tried to get because it's counted as equity when I tried to get a development loan, right? But I've also spent money to get that land to that value, right? I've paid for architecture, I've paid for engineering, I've paid for permits, all these things. And you would think that if I paid for all that stuff to create this value of the land, then I shouldn't be able to count those things that created this higher value of land, like architectural engineering, in my equity as well. Certain banks just aren't that sophisticated on their underwriting, and they'll let you double count. So they'll say, okay, now that this land is entitled, it's worth this much, and then uh, you put money on architectural engineering and on the permits. We'll give you credit for that too. And you're like,
Yeah.
oh, well, that doesn't make any sense, but okay, right? And so these capital market brokers have identified the banks that are less sophisticated and allow you to do that. So
Yeah.
maybe instead of bringing 25% in cash to a deal, like the bank intends you to, right? Maybe you're bringing 15%, right? And
Yeah.
so if I can pay somebody 1% and I'm bringing 10% less of the total deal in cash, I mean that really amplifies your return and saves you a bunch of time.
It's all just a return arbitrage and a time arbitrage when you think about it. I mean, that's the whole reason why you don't list properties yourself. You go through a broker, right? I mean, it's the same kind of idea.
Yeah.
Tap those networks, save yourself the time, let them do what they do, and let them specialize in what they specialize in.
To specialize in. Now, if you've
Yep.
got great local relationships, right, where you're getting really good terms, um, and it's small enough deals, you don't need to do this, right? So, all right, let's talk.
Let's
Go for it.
So I want to think about this in big picture, just stepping away. So, I mean, if you're trying to build, you're talking about the older guys that are just trying to cash flow, right? So they're really focused on long-term fixed rate debt. They're not worrying about rolling equity and growing anymore, right? They want long-term fixed rate debt to just cash flow and lower risk. Is
They
that
want they
fair?
want to sleep. They want to sleep at night, right?
Yes. Yes.
Preservation of wealth phase of their life versus growth of wealth phase. Yep.
Yep. So when we look at when a bank underwrites an individual investor, they'll underwrite deals specifically, but also you as an individual that's going to be lending or being the lendee from them. So anytime I'm thinking about building more in my portfolio, you probably can do this. You don't necessarily you want a few different you need income, right? You need some source of income because they're going to look at debt to income ratios, right?
Correct.
So if you're trying to build an ideal portfolio and you're going to do a couple things, you want a stabilized income portion, which in my mind is kind of this old man's approach, right? If it makes sense, have cash flowing properties that can be a portion of that income that helps you in that debt to income ratio. Then, if you're going to be doing development or rolling equity, then you have that portion of your portfolio, right? Because if you're just doing that side, you might be kind of hit hard on getting good lending because you don't have the income side. I mean, is there a way to think about that high level? of just
I used
portfolio
to think
structure?
that too. What's funny is different lenders look at different things, right? So, let me give you an example. This is pretty applicable to dentists and doctors and small business owners. Let's say you want to buy, 1 to 4 units of rentals. Okay. You know, according to the current like rules, like 1 to 4 is treated as residential. When you go out for a residential loan, they don't look at your commercial side at all,
Yep. It's
right?
just your personal, just your
So
personal.
it's your personal. So it's like you
Yep.
might be cash flowing the crap out of your business, out of your commercial buildings, just absolutely crushing it, right? All they care about is uh,
Personal tax return.
your debt to income and personal tax return,
Yep.
right? So
Yep.
what you can do is like you can play with that, right? Like your commercial stuff doesn't need to be profitable at all, as long as you can just keep buying 1 to 4 residential units, as long as your like debt to like residential income looks good, right?
Hmm.
So you can kind of steal, rob from Peter to pay Paul, right? So and then other things like liquidity, like some banks are like, most banks are like 10% liquidity, 10%, right? Some banks like don't care, right? And so, yeah, really, it's that's another reason like these capital markets brokers, they can kind of break it down for you pretty quickly, like who cares about what, so,
Yep.
and
So
then
like
deposits too, right? That's a big for banks. They love deposits. We can go through
having having a deposit relationship with that said bank. Is that what you're
it.
saying? Or what
Yeah,
do
if
you
you ever do research on like banking 101, like every dollar you put in, they lend out 90 cents, right? And then those people they lend out 90 cents to bring money in, which creates like another tier of money. So it's like, I forget what the
yeah.
number is, but it's like astronomical, like every dollar of deposits, what it creates for banks. So, um, yeah, that's another
Okay.
good.
Okay. No, that's good. That's good.
And
So you wanted to pivot to just talk about the specific refinances, some kind of case
yeah,
study, so to speak.
you've got a great, I think like as we both talk about, experience is the best learner, right? Like do your didactics. On Facebook, this week someone was asking about how to get into real estate. I was like, go on Amazon, download 20 books, right? And start
Yeah.
reading. But then you got to apply it, right? So let's talk about a couple applicable situations that you and I both have. So I've got a property, a commercial property that we ended up refining to get the cash out of, but it was when interest rates were going up. And so, they told us like an interest rate of probably like 6.25, but by the time we got that loan closed, it was like 7.6 or something.
Oh, geez.
Ridiculous.
Yeah, that's
I
a
was
quick.
like, I was like, well, I really want this cash to do some other stuff. I think it was like $1 million or something. So I was like, I'll do it for now, but I don't like this. And so I'm going to fix this later. So, two options on properties here, right? Interest rates are coming down. I called my banker and, this is a credit union. So what they have is a rate reduction tool. So if I pay 25 basis points, okay, my loan is a little under 5 million. If I pay 25 basis points on this one, I get to readjust my loan to the current interest rates. And I think this one's based off of like the 7-year treasury. So, if we do the math here, I mean, a typical loan's going to cost you, this is say like 1% to redo, right? So literally be paying like 48,000, right, to get a new loan or refi typically. But this little program through the credit union, is a quarter of that, right? So let's just say 12,000. Okay. So I can pay $12,000 and
Reset the loan. Reset the
reset the
loan.
loan. And I ran the numbers, but I reached out to my banker and I was like, hey, can you run the numbers for me? Because I want to make sure we're on the same page here. And for the rate modification, he said we are 7-year T-bill. And it's a 30 day, and then again, here's another little thing. Every bank runs their rate lock differently. Some you take the rate at close. So whatever the rate is of the day you close is the rate you get, or like 2 days before closing. This is a credit union. So they usually are like super helpful. This one's a 30-day look back.
That's
So,
good. The
so
best in 30 days.
best in the last 30 days, right?
Yep.
So that was 3.93.
But that's the treasury, not the rate, right?
It's the treasury, so it's the base, the index, and then you build a spread on top of that, right? So spreads used to be like 2.5% is what I saw the most, but then when interest rates are going up, banks see volatility, they see risk, everybody threw on a 3% spread. I can't get a better spread. I have been able to get 2.5 again with a couple banks, but I'd have to refi to do that. I have to pay the 48,000. Okay.
Okay.
So my spread is going to be 3%, okay, on top of that 7-year treasury index, the 3.93. Okay. So we're at 6.93. My current loan rate was 7.62. And again, he told me like, I don't know, it was like 6.5 when he quoted me before we closed, right? So this guy was on my shit list after we closed this loan, but I've kept up a relationship. They're a credit union, they're growing, they want to lend, they're hungry. So keep up relationships. So
Yep. So 0.5% drop, right? Is that right? Roughly
0.69, 0.69.
0.69. Okay.
Yeah. And so I look at this and I'm like, okay, 0.69. And then what does that do to cash flow? Okay. So what that does to cash flow is we go from 37,341 a month. On sorry, this is debt service. Cash flow goes on top of that. So 37,341. And he said we'd go down to 3,4,733.
So
So
shaves about a 3,000 off or a little less.
yeah, yep, 2,600. Now I can do this 25%. I can do this rate mod anytime I want, infinite amount of times.
Okay.
So it's not like a one-time wonder here, one hit wonder. So 2,600, and we know it's going to cost us 12,000. Okay, divided by 2,608, we have a 4.6 month break even. So when I'm looking at this, I'm thinking to myself, okay, rates have dropped, 4.6 month break even seems kind of like a no-brainer, unless rates are going to drop more.
Mhm.
So when I look at rates, the Fed is a part of this, but these are actually, the Fed doesn't actually control this, right? This is an open market, like the treasury market, right? It's based on demand. And I know Scott Bessent is focused on dropping this, right? This is one of his core things. And he actually has like a program that he is working on implementing where the banks can lend. What was the program? Basically, he said it could drop the basis. This is purely a regulation thing. It's not a free market thing. And we could drop the base 60 to 80 basis points. Okay, that's something he's working on, independent of the Fed. Okay, so we know that they're working on it and they want to lower these, but we don't know if it'll happen, right? All the tariff uncertainty, this is a free market, like these treasuries are based off of yeah, like the bonds. So it's like we just don't know where this is going to go, right? So do we take the bird in hand with a 4.6 month break even point, right? Or do we say, hey, I think rates are going to fall further over the next 5 months, right? And just kind of wait. And then that's option A, take it. Option B, wait. Option C is if I can get a 2.5 point spread with other banks, okay, instead of the 300 basis point spread. So it's the index, but it's also the spread. If I know I can get a 2.5 spread, but it's going to cost me, let's say I can negotiate. Like banks, once you get to know them a little bit, this is a stabilized property. I
Mhm.
might be able to push for, instead of a 1% fee, a 0.5% fee on stabilizes. This is like a very low risk thing for the bank. Long-term leases, stabilized. They love this stuff, right? Um, I'll put a bunch of deposits in their bank. I'll drop $1 million in their bank in deposits, right? They like me, right? I'm building things up. And now, let's say the rate's at 4% plus 2.5. We were at 6.9. Now we're at 6.5. So to put that in the calculator.
Now you're at more than a 1 point drop. So I know you're thinking there, but when I'm thinking about that, the main reason you can do that though is because the credit union doesn't have any prepayment penalties, so you could switch over to another lender without any issues.
Great way to state the key point there. Yep. That's
Oh,
my
sorry, were you gonna get there? Sorry, jumped the
no, no,
gun.
no, no. I wasn't gonna get. I mean, that is one of the assumptions I should have stated up front. Absolutely. So, all right. So we're gonna go down to a 0.5 loan. We're gonna go to a 6.5 interest rate. We're gonna go to a 25-year. Okay, well now we're at 32,409.
Is debt service, is what you're saying.
Is the debt service. So
So you
37,341 divided.
drop another almost 2 grand. Drop another 2,300.
Yeah, so we're at 49,32. 32. And the for future episodes, maybe I'll put this in a spreadsheet as people can see it in front of them.
People are like,
Like, oh, let's just get to the
so
end of here. So I said if I can get 0.5% times 4.8 million, we're at 24,000. And 24,000 divided by 4,932. Now we're at a 4.8 break even. Okay. So the amount of time to break even between doing this rate modification and doing a complete new refi is exactly the same.
mhm,
The risk to doing a complete new refi is it takes longer and rates
it's
might
fine.
go up. But after that 4.6 months, right? One of my options is cash flowing an extra 2,600. What did we say? 2,300 a month, right? Instead of after that 4.6 months, the break even to pay off those original fees. Um, Instead of getting 2,600 extra in cash flow a month, I'm now getting 4,900 extra in cash flow a month.
Can, can we look at that a little bit differently? So you're using it as like a break-even analysis. Why not look at it as a like an annualized return? Put your 2,600 times 12 months is your additional free cash flow. I'm paying 12K to do this loan mod through the credit union. So 12K divided by the additional $31,000 of rent would give you just like, what's my annual ROI? So it kind of projects out the returns a little bit further. It might give you a more fair comparison because after that break even point, like you were saying, your cash flow is so much higher on the complete new refinance that you take 4,900 times 12 and it's almost 60 grand. So maybe the ratio is the same, but it's I kind of look at it as a return on investment instead of a when do you break even. But maybe that's the wrong way to think about it.
No, I think all those numbers are how you want to do it. And then when I build it out in a spreadsheet, I agree. I like to look at it from all the different angles. So this is perfect. Um, So yes, so on our first one, we have the yearly divided by your original cost. So it's like a 2.6. Um, so that's good. 260% return. And then on the second one, I think this is great. Yeah, but I think what happens is the 1 year is going to give you a poor yeah, 2.46. So if you just do the 1 year return, it's going to look like doing the rate mod is the better way to go, right?
Mhm.
But I think this one, if it's a 7 year treasury index, it's probably fixed for 7 years. So and I probably had this 2 years, so let's run it on a 5 year
So extend it out.
because that's the reality, right?
The
Times
refi is going to win then.
the refi is going to win, yeah, but let's see by how much. Divided by 12,000. Okay, that's a 13x on your money with the rate mod. And then 4932 times 5 times 12 divided by, well, at the end of the day, it's how much cash does it make you, not so much your return, I think. Yeah, I think it really, at the end of the day, it's like net cash in pocket that it would matter the most. Cash flow as opposed to just an ROI. Because actually, 24, I think it'll still look better. Um,
I I think even if they're relatively the same, I'll let you come up with that conclusion. But I think if they're relatively the same and it's not too far out, then one in the hand over two in the bush kind of thing comes to make sense because you can always, as interest rates change, you can adjust again with the credit union versus a whole new bank, even though you might get a more competitive spread, the initial higher upfront cost, and also how flexible are they if it's not another credit union to
it
be
is another credit union.
Oh, so maybe it's the same. Maybe they offer the same uh ability to adjust down the rate at any point in time.
Yeah.
And every time you readjust the rate, do you lock it in for another period, or is it your 5 year term is still set?
5 year period is still set.
Yeah. Okay.
Um, so yeah, I think at the end of the day, put it in a spreadsheet, run all these different analyses, right? On this one, I think I'm gonna go after this discussion, and I really didn't want to prep too much on this because I wanted people to see like really how I process this stuff, right? So it wasn't like too prepared. I think at the end of the day, just doubling my cash flow from 26 to 4,900 a month on my extra cash flow
Mhm.
for an extra 12 grand, right? It's 12 grand for one versus 24 grand for the other. Like doubling that cash flow to me, that's kind of and because I have a good relationship with both banks, right? You got to look at all the external factors, like you said. They're both credit unions. Anytime rates are falling, I like to use credit unions if I'm going to refi stuff because they're so much more flexible, right? No prepayment
Yes.
penalties, all those kind of things. So I like to stick with credit unions in a falling rate environment just to keep that flexibility, like you mentioned. So, okay, Reed, that was the less complex one. I suspect in less complex. I know you have one that I think was it a multifamily building that you're
Yeah.
looking at?
Yeah.
Okay.
So instead of getting too in the weeds, since we did it with that one, I'll keep it like just I'll keep it more like high level so that
Okay.
it's maybe more interesting to people. So as we were talking about before, there's two different reasons you refi. One of the reasons you refinance is because you want to secure a lower interest rate, or a better debt product so that you can cash flow long term, right? That's one way. Another thing you might want to do is do like a cash out refinance so that you can harvest some equity from the property. And
Yep.
so we were talking in your situation more about just a refinance to secure lower debt to get better cash flow. What I'm going to talk about is that in part plus getting to harvest some equity from the property. So that's kind of like the strategy. If you're doing heavy value add real estate, specifically in multifamily, one of the strategies people use is you buy the property, you use whatever kind of debt you can, hopefully with no prepayment penalties. That's what we were kind of discussing there. Um, you force an increase in value in that property, and then you refinance into a better loan product and get some cash out at the same time.
Yep.
Josh had mentioned agency debt. So one of the things you want to do is focus on agency debt with multifamily products because typically the interest rates are a little bit better. There is some strict criteria around what qualifies for agency debt. But if you satisfy those criteria and you plan for it, you typically get a longer fixed rate debt. And so typically that's the kind of the strategy. Kind of a short-term loan product, refinance into a long-term loan product, and you pull out some money at the same time. So the property I'm referring to is a 72 unit multifamily deal that we bought like maybe 14 months ago.
Okay.
So yeah, we bought about 14 months ago. I think we paid around 4.5 for it. Um, we're currently getting it refinanced with Freddie, uh,
Okay.
and we should close within the next week on it. Refinance with Freddie at, let's see, a new loan amount of 6.2 million based on the new value. So quite a bit of a jump there. And we're able to pull out roughly 60% of our original capital. So I think that was something like our original capital might have been, I didn't have this written down, but it could have been like, call it 1.5 million or something like that. So essentially what we'll do is we'll get $750,000 back to our partners from this project, maintaining another 45% of our original capital in the deal, and then we'll cash flow after that. So how do you decide, how much money you want to pull out versus, how much do you leave in the deal? A lot of it depends on what the lender will do for you because they want to satisfy their debt covenants, which are usually debt service coverage ratios, as we mentioned. They want to just make sure there's enough cash flow after or prior to debt service that you can cover the loan. So they usually set those criteria. So it's really just a straight calculation of what is it typically on agency debt? 1.2 is the,
It depends.
yeah,
So if you go on like the Fannie and Freddie sheets, right? It's usually like, I don't know, 2 or 3 pages. They've got little things. Uh I think, I like HUD 223F. That one now, oh, I just did this last month. Man, it's nuts. It's like 1.16 now.
it's
Uh,
lower.
yeah, it's lower than the other ones, but yeah, I would say 1.2 sounds about right. I have to pull up the cut sheets.
So the thing that we looked at, HUD, we looked at the specific loan product, and I think there was enough origination fee, enough holdback and reserves that it was kind of like, and then I think their prepayment penalties were higher as well. So with that
On the
HUD product,
HUD. Yeah,
yes, than the
yeah.
Freddie product.
If you're not putting it to bed for 30 years, right? You're like, hey, you'll probably end up refining again in five
Yeah.
years or something. Yeah, it makes sense.
So I think the HUD product works like maybe you have a class A building or like a really nice asset that you want to hold for, like you said, indefinitely in cash flow, then I think that's the way to go. But oftentimes you have to keep your exit in mind. What are you going to do with this property? Is it just a cash flow play long term? Or do we want to harvest as much equity as we can, roll it into the next one because we're in that building phase? And
Yep.
that's where the high level decision making comes in. So we are doing a little bit of both. With a cash out refinance, we can kind of, I can pull out my equity and roll it into another deal, but I'm still after I pull out my proceeds here in this specific project, I'm still cash flowing like 10 to 12% on my remaining equity. So that's
Well,
not bad. Yeah.
that's great. Great.
Yeah.
I think you bring a big point too here. This is one of my fundamental concepts I like to drill home is people like look at like I was doing this with the lady at the gym this week. She bought a house in a nice neighborhood, turned into a duplex. She was asking me questions, and I was like, I was running the numbers in my head when I was talking to her. Like her return on her original equity was very good, right? But now that she's already value added, like we talked about, her return on her current
Current
equity
equity.
wasn't that good, right?
Yep.
It's usually between 2 and 5% when I wrote for folks, right? And so exactly what you're saying, like if you're in the building wealth phase, you got to pull that equity out so you can get those outsized returns, 10, 15, 20, 100% agree. That makes sense.
And I think what I consider this, right, is if I'm looking at my total portfolio and I'm trying to make this decision, it's one of those things I make a decision for is like, well, I don't have enough in my mind assets that are just straight cash flow. Like I want one more in that bucket. So then I make that decision to just pull out some and keep that thing cash flowing and then redeploy in the other versus I'm going to pull out every dime I can, right? And it's going to be a little skinny, but now I don't really have as much cash flow. So sometimes I make those decisions as well, just based on what my overall portfolio looks like and not just what I can maximize with my return. It's a little bit of like hedging and a little bit of risk
Oh,
mitigation. But also, one more side of that is taxes. So if you hold something long term, you cannot reset your tax basis, right? So like is well, I should say this, anytime you buy a property, you have heavy depreciation on the front end of ownership. If you hold it long term, you're kind of using up that bucket of depreciation.
yep.
So eventually you need more depreciation to offset income gains, that sort of thing. And so sometimes you roll because you want to get a new step up basis, right, into the next property and start getting more depreciation.
You need the depreciation, 100%.
So that's another part of the equation.
I think you're right. I mean, I think there's a certain point in life, right? One of my friends, he always jokes that he's not rich, his grandkids are, because he owns all these properties, right? And they have like 25, 30 year loans on them, right? His kids are 30, 40. By the time they're 60, this stuff will start getting paid off, but his kids won't even care, right? Because they're 65 and they're doing okay. It's the grandkids it'll be,
Kids.
yeah. So I agree. I mean, I hate paying taxes. And so I mean that's I got to pull out and keep buying stuff or building stuff so I don't pay those taxes. Um I agree. And then eventually, your debt, even if you still have a payment, let's say you paid it off, like we talked about, the your revenue grows faster than your costs around these buildings. So eventually the loan payment is just a smaller percentage, right? If the loan payment right now is, half the cash flow, in 20 years, it's a quarter, right? And so they're putting off this heavy cash flow. When you have enough and you've accumulated your portfolio, you're putting off that much cash flow, and you just want to enjoy life and enjoy your grandkids or whatever, right? Now all of a sudden you're like, I just want to hang out with my grandkids. I'll pay the tax.
Yep.
Uh, but until you get to that point, you don't want to pay that tax. That's money you could have used, right?
No.
So I do feel like, I don't, the phrase we all really like is don't let the tax tail wag the dog, right? And I think some of these tax schemes are very complex and PPLI, like the Iroquois Nation of New York or something. Like there's all these little tax games, but there needs to be a fundamental business underlying those that really works, right? Or else it's just a house of cards. So, but we've talked about this before. Interim taxation is, in my mind, the number one wealth killer, and I've shown the numbers. And this week on Facebook, I just put up a chart. I think it was like 25 years, stocks versus real estate, right? And putting in like 200 grand a year. Stocks came in at like 16 million after like, I don't know, 25 years and or 20 years, I forget. And then real estate returns, this average real estate returns on like normal real estate was 54 million. 16 versus 54, right? So it just doesn't make any sense to pay taxes because you can just keep compounding your curve, right? Your
Yes.
compounded growth curve. And if you're paying those taxes along the way, your curve is not going to look nearly as nice. You're just going to be, if you're in dentist, you're going to be grinding in that chair like another, 10 years if you're paying those taxes up front. Um,
There, there's one thing I thought of as you were saying that. Even if you said I'm the grandpa that doesn't care if I pay the taxes, right? But one of the things that people do sometimes is they every so often will refinance and pull money out tax free, even if they're not getting depreciation, right? So you can do that too. If you have 20-year notes and every 10 years you do a refinance and set the schedule back to 20 years, you could pull out equity that you just built.
Yes, absolutely. You can pull out the equity. Yes, live off that, and you're just paying taxes on uh, the problem is you pay cash flow on income before debt service, right?
Yeah.
So, uh,
Yeah.
yes, you can, but you're still paying the taxes
Yeah.
through the income you're using to service that debt you just took out. Um,
It's kind of spreading it out more, I guess. You get that kind of tax-free lump sum and then you reset, you will pay it long term.
you're right, you're deferring,
Yes.
but that's a good strategy too, right? Like it's the what's the one they always advertise in the clickbait news articles, that's actually true. The like when Musk took the money and took his stock from Tesla and leveraged that, took a loan on that to buy Twitter.
In
uh,
the securities back like line of credit kind of thing.
yeah.
Yeah.
So you just keep doing that, and then you'll be able to buy stuff without paying tax on the money or selling, right? Having to pay capital gains or depreciation recapture. So you're right. That's a better strategy.
Yeah, it's at least one more. And that's the whole point is right, is like once you build equity net worth, you can play with it differently. You have different strategies that open up to you. And real estate offers the most strategies, I would say. I mean, it comes with the least most straightforward strategies for mitigating that interim taxation.
Yeah, and then every year it's different. I mean, like the opportunity zone stuff, right? Like I love that stuff now, and I'm excited to see what's in this tax bill. I think that's
Yeah.
going to be a good play. Um, all right, Reed, thanks for hopping on today. Always fun to chat with you and bounce it off each other. It's super fun. Let's see here. I think that's it. So thanks for tuning in to the Dr. Josh Cochran Show. We appreciate Reed Faldet, the Wonder Kid, hopping on today. Wealth, health, family, freedom. This year, commit to building the future you deserve. Thanks, everybody.
Thanks, Josh.
Thanks, buddy.